Hello, welcome back to the show. So in today's video, I'll be covering super investors buys in Q1 last quarter. So in today's video, I'll be covering a few things. We'll be covering super investors buys in Q1, why pricing power is so important, as well as some questions that you guys have left me in the comment section below. So let's talk about the first super investor first. The first super investor that reported was Chuck Akre. So Chuck Akre over here in the past 10 years, his fund has returned around 271%, whereas the S&P 500 has returned around 200%. Chuck Akre is no longer managing the fund. He's since retired, but his fund is still vastly outperforming the S&P 500 over here. So for Chuck Akre over here, ever since he stepped down, the fund managers have been basically selling out of the core positions that got him these returns over time. So you're seeing MasterCard that's being sold off 10% this quarter. You're seeing Moody's selling off 20% as well, selling out of some Visa as well, selling out of American Towers as well. So overall, I'm not a fan of what the management is doing right now, the fund managers, simply because they're selling out of core positions like MasterCard, Visa, Moody's, and even American Towers as well, and buying into companies like, for example, Airbnb over here, Brookfield Management, as well as CCC Intelligence over here. So they're selling out higher quality businesses to buy lower quality businesses. And for me, I think this fund over here, the philosophy changed as soon as Chuck Akre he stepped down. So this is Chuck Akre's notable buy over here, his fund. So his fund bought a substantial amount of Airbnb last quarter, and Airbnb is a company that is currently now trading at around a 34 times earnings. So for me, I think Airbnb is a company that has a decent sized moat, but there are two problems with this business itself. Number one, it is a company that is facing too much competition. Number two, it is a company that has too much regulation. So competition wise, you have company like Booking, you have Expedia, you have Trip.com, all these different companies, they form the travel space as well. Although Airbnb is primarily for homestays, you're seeing Booking coming out with their homestay portions as well. And I'm sure Expedia and Trip are also exploring those portions as well. So that's one part. And then the other part is simply just regulation. So there are cities, there are countries that are limiting Airbnb usage. So for example, in my country, they block out Airbnb, and so no one can host an Airbnb in this country over here. And I'm sure other cities will explore this portion as well. If they think this Airbnb concept is a bit too intrusive for all its residents or people are exploiting it. So that is another portion of the business that I don't like as well. So there's a better alternative in your travel space, and I think Booking is a better alternative. So although Booking is not a company with a substantial moat, it's a company with management that is incredible. So if you're to look at the Booking Holdings management itself, the capital allocation is just simply incredible. All they do is they do a lot of buybacks, and they give out substantial amounts of capital back to shareholders. They treat stock-based comp as real expense, and they try and limit it as much as possible. And their management's compensation are all tied to the stock price itself. So if the stock price appreciates, then your management will make money off of it. So it's sort of like a win-win situation as well. So for Booking over here, I think it is a company that is quite decent in terms of its quality, although it is not a high moat business. If you have to look at the fundamentals itself, it is an incredible business that has compounded its fundamentals over the past 10 years or so. Even during COVID itself, it was earning profits. So for Booking over here, I view this as a better alternative. Booking is clearly competing better, fundamentals are better as well, and the valuation is a lot cheaper than Airbnb itself. Next fund is George Tarasoff. So George Tarasoff, he basically manages around $289 million. And for me, if you were to look at his holdings itself, he owns a substantial amount of Amazon. He's been trimming out of his Amazon position. He trimmed around 10% last quarter. He owns Berkshire, Brookfield, as well as Markel as well. So all these three positions over here, they make up around 50% of the entire portfolio. And then he owns this Trupanion stock as well. This is a more speculative bet, around 10% of his portfolio. He owns Tesla as well, around 7%. Google is a decent company, but it's one of his smaller positions. And then there's another speculative bet over here, Burford Capital. I believe is an asset manager as well. So for George Tarasoff over here, he's selling and trimming his core position in Amazon, and he has a large stake in Berkshire, Brookfield, as well as Markel, all of which are asset companies. So for George Tarasoff over here and his fund, I think you're better off just simply buying all the different asset managers. So just buy Berkshire, just buy Brookfield, just buy Markel. You will have more alpha if you have to do that, because you don't have to pay the expense fee that George Tarasoff will charge on you as well. So I think George Tarasoff, his portfolio in general, so I don't agree with how he manages his fund. He has 50% of his portfolio in asset managers. So why not just buy the asset managers itself instead? Next fund is Polen Capital. So Polen Capital over here, they manage around $31 billion. This is just incredible amounts of money. They manage more money than Bill Ackman, Dev Kantasaria, and Michael Burry. So all your different famous super investors, Polen Capital manages more money than all these investors combined. So for Polen Capital over here, if you have to look at the portfolio itself, it is just incredibly high amounts of activity. I don't agree with this. So if you have to look at the entire portfolio itself, they've been trimming and selling and buying almost every single quarter, and the activity every single quarter is just incredibly high. Also, they've been selling out of their core positions like Amazon, Microsoft, Visa, MasterCard as well. All these are high quality businesses and they're selling out of it. So I don't particularly agree with this one. And they've been buying companies like Oracle. Oracle is a company that is in the cloud computing space as well. And then you have another buy in Eli Lilly as well as Zotis. So let's talk about their notable buys this quarter. So the first company that they bought heavily into is Zotis. So Zotis over here, they're the largest animal pharmaceutical company, and the fundamentals itself looks like a high quality compounding machine. So they have secular growth trends in terms of your animals and increased adaptability of your animals. But for me, I think Zotis is a company that is trading at too high a valuation for its growth. So this company over here, it is projected to grow at around 9 to 10% for the next few years or so. And trading at a 27 times earnings, growing at 9 to 10% is a bit steep of a valuation. So although Zotis is a company that I've looked at, number one, I don't understand the business and the patterns itself. And number two, the company is simply just too high a valuation for me to invest in. Next notable ad that he had was Eli Lilly. So Eli Lilly over here is a company that is currently now down around 7% year to date. And the company now is trading at 58 times earnings. So it is the largest pharmaceutical company in the world with the most effective weight loss drug. And with your weight loss drug projected to grow at around 20% over the next 5 years all the way until 2030, Eli Lilly will be a massive beneficiary of it as well. But the problem with Eli Lilly is this: the company is trading at too high a valuation. So it is trading close to 60 times earnings. And when you have a competitor in Novo Nordisk trading at 19 times earnings, I think Novo Nordisk is a better bet right now in terms of its valuation and its stock price. So for me, Eli Lilly is an avoid as well. The third ad that they had was Oracle. So Oracle is a company that's trading at 38 times earnings, and Oracle is competing with Amazon, IBM, Microsoft in your cloud computing space. So for Oracle over here, the problem with the business is Oracle is more expensive than Amazon, and they compete with Amazon for cloud services. And Amazon's AWS is actually growing a lot faster than Oracle's cloud computing portion over here. So why not just buy Amazon instead of buying Oracle? Oracle is a company that only holds around 4% of the entire cloud computing space. Why not hold a company that holds the majority of your cloud computing space over here? Next fund is Thomas Russo. So if you don't know who Thomas Russo is, Thomas Russo was one of the higher ups in your Lehman Brothers as well as your AIG that was responsible for the 2008 great financial crisis. And for his fund over here, he manages around $9 billion. So for Thomas Russo over here, again, there's a lot of activities. The problem with all these funds over here is they have a lot of activities in one single quarter. So if you're to look at almost all the super investors, they trade in and out of their positions almost every single quarter. And that is what I don't like over here. And same story over here for Thomas Russo. He's selling out of his core positions. So he sold out of Berkshire, he sold out of MasterCard, Google, Philip Morris as well, and he added Uber as well as DoorDash. So DoorDash and Uber were his notable ads this quarter. So let's talk about the first notable ad for Thomas Russo over here, and this company is none other than Uber. So Uber is a company that is apparently trading at 15 times earnings. So Uber is a company that has a wide network and ecosystem, but the problem with Uber itself is it faces risk of disruption. So although there's not much talks about robo-taxis taking over Uber right now, Uber is a company that will face this threat in the next 5-10 years or so. And so if you're thinking of buying Uber and holding it for 10-20 years or so, I don't think that is very possible because the possibilities of your automotive vehicles coming in and taking Uber's market share is extremely possible. And for Uber over here, it is not a company that is trading at 15 times earnings. So it is only trading at 15 times earnings right now because of the tax benefit as well as the equity gains that they included in their income statement over here. So if you have to go and calculate Uber's price to earnings itself, Uber is trading at a real price to earnings of around 45 to 50 times right now. So it's a company that is trading at quite high valuation, growing EBITDA at around 20 to 25%. So it's around a 2-pack right now. So for Uber over here, I don't think it's a company with an extremely wide moat, and that's why I'm not intending to invest in this one. I think Google's Waymo app has a lot more upside as compared to Uber over here. The next notable ad that he had this quarter is DoorDash. So DoorDash is a company that is trading at 271 times earnings. So for DoorDash over here, it is a company with the largest market share in your food delivery space in the US, but the valuation for this one is a bit too steep. So when you have a company that is trading at 271 times earnings, the only way for you to justify this valuation is for the company to grow at 30% for the next 5 years or so. And I don't think that is very possible for DoorDash over here. So I'm more comfortable with DoorDash than Uber simply because DoorDash is less prone to disruption risk as compared to Uber over here. But for DoorDash, I won't be investing in this one as well, simply because the valuation is too high and it is a company that is still pursuing growth rather than moving towards profitability. Next fund is AKO Capital. So AKO Capital over here, they have around $7 billion in assets under management. So for AKO Capital over here, they own a lot of high quality and familiar names. So for example, Visa over here, MMC, it's an insurance company, GE, another holding that Chris Hohn owns, Microsoft, ICE, all these are high quality businesses, even Moody's, Intuit, Booking, Waters as well as Copart. I think out of all the funds that we've talked about earlier, this set of stocks over here are one of the high quality ones. So they've added to a lot of their positions and they added quite substantially to Moody's over here. I agree with this one. Moody's is a high quality business that will just keep compounding over the next few years. And they've added other companies like, for example, Microsoft as well. Microsoft at $330 was quite an undervalued price, and they managed to add it at around $375, which is on hindsight a decent add as well. Next fund over here is Mohnish Pabrai's fund. So Mohnish Pabrai, he only owns 4 stocks over here. He owns this coal company, VAL, AMR, another coal company as well as this company over here, which is NE. So for Mohnish Pabrai over here, what he is doing is he is basically buying up all your deep value plays in coal. I don't really like this investment approach. And for Mohnish Pabrai over here, he is doing opposite of what he teaches. So he has always been crowned as the Warren Buffett copier, but if you were to look at his activity itself, he's doing the opposite of that. He's not buying companies that are of high quality. Instead, he's pursuing all these different coal bets, which might be paying off. But over the past few years or so, his performance hasn't been up to standard. And for his portfolio over here, I don't think it is replicable for anyone. He probably understands this business and that's why he's allocating 40%, 23% of his entire portfolio in all these different coal stocks over here. But for me, for normal investors, I don't think this is an approach that anyone can take. Next portion over here is on why pricing power is so important. This is from Chris Hohn over here. So this is what he had to say about pricing power.
Go back to the point about growth can come from 2 forms, price and volume. Okay? And most companies don't have pricing power. They can only price, if they're lucky, at inflation. And that's why people don't focus on it. They don't even look at where growth comes from. They just assume it's volume plus inflation. But there is a special group of super companies that can price above inflation. And that's, as Buffett taught, the test of whether you have the moat. Okay? And this real pricing power above inflation can be very valuable. Because if you can price 1% above inflation and you have a 20% profit margin, your profits will grow 5% faster than revenue. And people don't go into it or analyze it because there's so few companies that have it. But this is something we have a lot of our investments have this.
Because incremental pricing is pretty much all profits.
That's right, and it's very potent if you have the lower your margin is. So this is why you asked about growth, and is it how important if you ask about volume growth, but I have low volume growth, but I have a lot of pricing growth. That's actually more important because of the leveraged effect of there's no cost associated with it.
So what Chris Hohn has said over here is that pricing power is extremely important. So when you want to own companies with extreme pricing power because they'll be able to increase prices at levels above the rate of inflation. And so when there's an inflationary environment, these companies, they will grow earnings on top of inflation itself. And when you have a company that can simply just increase prices without having much volume growth, like for example FICO, you can have EPS growing at 20% even though the volume is stagnant. So for example, a company like FICO has been able to increase their prices by around 5-fold since around 5 years ago. That's around, I believe, 500 to 600% since 5 years ago. So that has led to increased EPS over this past few years over here. And this year as well, they're projected to increase the cost of their FICO score from $3.50 to around $5. So that is incredible pricing power. And although the volumes for all these different consumer ratings over here have declined in the past year or so, FICO has still been able to increase their EPS by 30% over the last year. So when you want to own companies with incredible pricing power so that they can compound intrinsic value over time. They can grow their earnings at a faster rate than their revenue itself. Last portion over here, I'll be talking about some questions that you guys have left me in the comment section below. So the first question over here, it says, you mentioned that you do not get involved in healthcare often for various reasons. Understandable, but I was interested in how you see Merck. I feel it is a strong financial based company that is quite undervalued as well. Great dividend as well. Any thoughts are appreciated. So for Merck over here, it is a company that is extremely undervalued. So if you have to look at the fundamentals itself, it is a company that is sound, currently now trading at 10 times earnings, having a dividend, I believe, of around 3 to 4% or so. So for Merck over here, it is a company that I don't understand simply because they have a lot of patents in play, and I'm not too sure how their pipelines work and how the actual products are doing. But for me, I think pharmaceutical companies, they are normally out of my circle of competence. And so for Merck over here, it is a company that is slightly undervalued. Buying now will probably yield you positive returns over the next few years or so, but it is out of my competence and I don't understand this business at all, and that's why I'm not planning to invest in this one. Next question over here, thoughts on owning ASML as a small part of a portfolio. So for ASML over here, it is a company that has extreme wide moat. So I own quite a sizable amount of my portfolio in ASML as well. And for this business over here, I think it is an extremely high quality business. Currently now trading at around fair value. So my fair value for ASML is around $750. Currently now the stock price is hovering around the $750 or so. So my thoughts on owning ASML as a small part of the portfolio, I think ASML is a company that is extremely high quality. It will likely beat the markets over the next few years or so. And it's a company that has a large install base. So the install base will just keep growing and every machine will last more than 30 years or so. So this install base portion will just keep growing and growing every single year. And then they have their sales of their machines as well. That portion will also continue growing with the increase in your AI and all your capex spend and so on as well. So for example, TSMC, they've been heavily investing in the US as well. And if they can migrate all the different fabs to the US as well, then you could see a lot more tailwinds and a lot more growth for ASML over here. So for ASML over here, I view it as a company that is fairly valued right now. It's a company that will likely give you outsized return over the next few years. And so for ASML over here, my thoughts are that if you're to own a small part of your portfolio in ASML, it will likely give you alpha in the long run. Last one over here, Google is a great buy. Thank you so much for watching this video. I hope you guys have found this one useful and invest safe.